Thanks for joining us today on Market Call. I'm Morella Fernandez. Jordan Zinberg with us on the show. He's president and CEO of Bedford Park Capital. He'll take your questions on Canadian small and mid-cap stocks. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can also send an email, marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thanks for having me.
Small and mid caps have been largely left behind for most of the year, but I'm guessing you're seeing that change in the last month or so?
It's been a very strange year. We've seen a lot of different things this year. We've seen Canada outperform the U.S., both large and small cap. Within Canada, small caps have done extremely well, but the breadth has been very narrow. I was talking to somebody on a trading desk yesterday, and he told me 80% of their volumes this year have come from mining stocks. So there has been a small cap rally. But interestingly enough, it's been very narrowly focused in the resource sector. So investors outside of that sector haven't done as well, even though the small cap indices are up quite a bit this year.
What do you think has been driving the markets overall? Is it resources?
Absolutely. I mean, if you look at the attribution on the TSX or the TSX small cap or the venture, even more so, you'll see a very large proportion of the gain has come from mining stocks. And that's really done two things. I mean, it's rewarded mining investors who have been suffering for many years now. But not only that, it's been drawing capital out of the non-resource names. So you have a lot of the non-resource small cap growth stocks that have just been left behind in this rally this year.
Okay. Have any of the small cap, mid cap tech benefited from the big AI run?
It's interesting. Small cap tech in Canada actually hasn't done that well this year. There's been a couple standouts, but overall, I think if you look at Canadian small cap tech, and let's face it, non-Canadian investors don't come here for our tech companies. They come here for our resource companies. So in order for Canadian small cap tech to stand out, they really have to do an incredible job. And a lot of times they end up getting bought out by bigger peers.
Okay. So what do you expect to be the themes for both the end of the year and the start of 2026?
So I'm not going to call an end to the mining rally. I mean, typically we see mining rallies like this every 5 to 7 or 8 years in my experience, and they can last for a year or 2 years. So I'm not going to sit here and pretend that I know when it is going to end. It is going to end at some point. You'll see capital start flowing back into those non-resource growth stocks that we specialize in. And I think you're starting to see it now. You're starting to see fundamental buyers looking at these valuations and just seeing how crazy it is that you can buy these profitable growth stocks on such low multiples.
Would you call them a defensive move to move back to the small and mid caps that way?
I think, for the last several years, you've really seen a bias towards large cap. There's been a lot of institutional capital that's left the small cap space. But for somebody who sits in my chair, that just creates more opportunity. There's less eyeballs looking at these stocks. They're priced more inefficiently. You're seeing more dislocations in the small cap market. So I'm excited. Despite the fact that a lot of names haven't done well this year, I think the setup from here for investors in small cap growth is excellent.
Okay, we're going to take a quick break. We'll line up some phone calls for Jordan Zinberg of Bedford Park Capital. Again, he's taking your questions today on Canadian small and mid-cap stocks. Back a moment. Welcome back, and thanks for joining us here on Market Call. We are going to start right now with an email from Stan. He has a question for Jordan. He says, can I please have Jordan's opinion on Enterprise Group? Enterprise is utilities, is that correct?
Traditionally, it was an energy services company, although they're going through a very interesting transition right now. So for those who aren't familiar with the company, they would typically provide equipment for oil and gas sites, things like rubber bumpers that trucks would drive over, lighting, things of that nature. A couple of years ago, they got into the power business. They started renting turbines that would allow energy producers to power their sites with natural gas as opposed to diesel, which is not only much cheaper for the customer, it's also way more environmentally friendly, obviously. And that business has very high margins, which is what attracted me to the company in the first place. Typically, energy services businesses would have much lower margins than enterprise. They put out a very good quarter, ahead of expectations. Stock reacted well. I think the big thing, Stan, for you and others watching this name is that management is intending to transform this into more of a pure power company as opposed to an energy services company. And if they're successful over the next year in doing that, on the back of their acquisition of Flex Energy Canada, I think you'll see the stock re-rate and be treated more like a power or infrastructure company as opposed to an energy services company. So you could see it trading at a way higher multiple as this transition goes through. I wouldn't even be surprised if you see them change the name of the company to better reflect where they're going strategically.
Interesting. Okay, I hope that works for Stan. Let's go to our first caller. Mike is calling from Guelph, Ontario. Hi, Mike.
Hi, gang. Just inquiring to Jordan regarding Kraken Robotics. I think they just released earnings as of late, and there's a bit of volatility, but nothing really hit home in terms of positive increases or negative, but there seems to be quite a bit of volatility. Just wondering what Jordan's thoughts are on Kraken, please.
Okay, Kraken Robotics we have up here now. It's at 565 today, so a little down sort of in the fall, peaking earlier at 7:30 in October. Big defense sort of spending going on globally. Is Kraken participating in this?
Absolutely. I mean, I have a fairly long history with this company. I actually started buying the stock around 50 or 60 cents, probably 6 or 7 years ago.
Okay.
That was when it was still under the old CEO. The current CEO was the CFO at the time. So I know the company pretty well. Their products are incredible. If you've ever seen the underwater drones and things like that they make. Interestingly enough, the first products the company made were actually used for treasure hunting, where there were people who wanted to go down deep into the ocean and
finding metals underwater?
Yes,
okay.
finding sunken treasure, believe it or not. It's morphed into a way more robust offering. Obviously, they're working with several navies all over the world. Products are very good. Growth is very good. They're in a hot sector right now. I would say those are the positives. On the negative side, this is a business that will be lumpy. So they're dealing with contracts with big governments and navies and armies and defense budgets and things like that. So you're sometimes dealing with a case where they think they're going to get a contract and they may get it, but it may take an extra 2 or 3 quarters. I think the biggest reason why I don't own this stock right now is just simply valuation. Everybody's gotten very excited about this stock. It trades at a huge multiple, and it's going to take some time for the company to backfill that valuation in order to justify even the current levels we're at now. So I think it's a great company with great products, well run. They've made great strides over the last 6 or 7 years. I'd just be a little cautious on valuation.
Talk to me about competition in that space, in the underwater defense space.
There are competitors. Yeah. Obviously, each one will talk about the merits and virtues of their products. And I think for somebody like me or viewers who are on the outside who don't really have the ability to judge which underwater drone is better, I think that comes out over time in the numbers. I think as you see Kraken win more and more contracts, or their competitors, whoever's winning the contracts, that acts as your validator for the technology. So in cases where you can't actually understand the technology on a deep level, I think look at the revenue, look at the contract wins, and that will tell you over time who has the best products.
Got it. Okay, let's go back to the phone lines. Elliot is on the line. He's in Hamilton, Ontario, with a question. Hi, Elliot.
Good afternoon. Having successfully done this model once with MTY, can this individual repeat it with Happy Belly Food Group? Your assessment, please, and would you start a position here around $1.70? Thank you.
Thank you for the question. Happy Belly. What do they own? Give me some idea of the sort of the product they have.
Yeah, sure. It's a collection of fast food or quick service restaurants. And what the caller was alluding to is MTY Food Group, who's been the biggest player in the space in Canada for many years. Again, a stock I'm very familiar with. I watched them grow. I watched their growth slow. I watched some missteps along the way. I got introduced to Sean Black from Happy Belly probably about 3 years ago. The stock was 15 cents at the time. He was just getting started. I was extremely impressed with him. He's one of the most passionate CEOs I've ever met. He's done just an outstanding job putting this company together. They're growing like crazy in Canada. They also have signed some agreements in the US recently. So they typically acquire smaller brands. Let's say there's somebody who's come up with a concept and they have 2 or 3 or 4 locations. Happy Belly will come in, buy the company, and then use their expertise in both real estate and operations and marketing and branding and all of those things to grow that brand. Usually from a franchise perspective, although they do have some corporate stores. So the playbook is there for Sean. And, similar to my comments on Kraken, I love everything about this business. I think the valuation's gotten a little bit ahead of itself. And that's really a testament to Sean, the CEO. He's just done an incredible job getting people excited. And I do think he will backfill this valuation. It'll just take a little bit of time. But again, he's done an outstanding job and he's made incredible strides over the last couple of years. So hats off to Sean Black.
It sounds like a difficult business to be successful at competition-wise, and also distribution would be difficult across.
Yeah, the key is to have a number of different brands across different verticals. I mean, MTY went through this years ago trying to diversify, so they wanted to make sure they had an ice cream brand in the summer, for example, and then brands better suited to the winter, brands suited for different climates, different tastes in different regions and geographies, different menu items. So there is a secret sauce, so to speak, but the playbook is there, and I have a lot of confidence that Sean's going to be able to execute.
Okay. And again, competition in the space would be?
Well, the main competitor would be MTY Foods, who owns a number of different brands. But I think any fast food chain, so think about McDonald's, Subway, and any chain you can think of is competing with the brands that are owned by Happy Belly. Their brands are just emerging, so some people might not know their brands as well. But some of the key brands are Heel, Rosie's Burgers. They've got a Greek brand. The name escapes me right now. But they've really done a good job diversifying their product offering over the last couple of years. This is a new young company. It's really exciting. And again, I just think valuation's a little high. I have a hard time buying it at $1.70 right with what they have right now. But we're watching the company closely.
Okay, we're going to take a quick break. We're going to be back with more phone calls and emails for Jordan Zinberg of Bedford Park Capital. We're taking your questions on Canadian small and mid-cap stocks. Back in a moment. Welcome back to Market Call, and thanks again for joining us. Let's go back to the phone lines. We have on the line Curtis in Regina with a question. Hi, Curtis.
Hi, Marilla and Jordan. Jordan, I know you've been bullish on NTG Clarity in the past. I was just wondering if you hold it in your portfolio still to this day, and would you add it this time? Thank you, and I'll hang up and listen.
Okay, thank you for the question. Tell me about the company.
Sure. Easiest way to explain the company for those who aren't familiar is if you're familiar with the large Canadian tech company CGI Group, which is an IT services company, I would say NTG is very similar in terms of the types of services they provide. The big difference is that they operate in Saudi Arabia and neighboring countries. So it's a geographic focused IT services company. Really came onto my radar over the last year or so, and I think a couple other radars as well, although the stock's not very well known. They've done a great job growing the business in a very profitable way over the last couple of years. The stock sold off recently, and you can see it on the chart there. Last couple of quarters, they've been investing in the business. And as a result of investing in the business, the profitability has suffered a little bit. It's still a profitable business, but what happens is they'll win a contract and they'll have to hire the staff for that contract in advance. And sometimes that contract can get pushed a quarter or two, so they end up carrying a bunch of expenses for that staff. They can't let the professionals go because it's hard to find these people.
I was going to say, how unusual is that model?
It's not unusual. It's just because they're a bit of a smaller company, I think you feel it more. If it was a much bigger company and they just had to staff up for one contract, you wouldn't really notice it. But in this case, you'll notice it a little bit more. So spoke to management recently. They've been investing in the business. They've been winning larger and larger contracts. Company's well run, high inside ownership. I think long term, this probably gets taken out by a player who wants a presence in that specific geography. Saudi Arabia has an initiative right now to diversify away from oil, and they're spending billions of dollars on their tech industry and tech infrastructure and encouraging companies to come there and operate. So the company's in a really good place. It's small, it's unknown, it's growing fast, it trades at a really low multiple. So I think, would I buy it here? Yes, I would. Do I still own it? Yes, I do.
Okay, and they're operating out of Markham, Ontario, which is just outside of Toronto. Okay, yep. Let's move on to our next caller. Then Mike is in Toronto with a question today. Hi, Mike.
Hi, I'd like to ask about Lumine Group. It's kind of got dragged down, I believe, maybe with the Go Easy issues going on, and Constellation and the others all kind of falling together. Do you think it's a buy here?
Okay, thank you for that question. Communications and media software.
Yeah.
And I'm wondering about the whole software angle with the questions about AI and perhaps the need for software these days.
Yeah, and I think we'll get into that a little bit later on in the show. But at a very high level, for those who aren't familiar, Lumine was spun out of Constellation Software a couple of years ago. It was their media and communication division. So a couple of years before, Constellation had spun out Topicus.com, which was their European division. Their second spinout was Lumine, which was a sector-focused spinoff as opposed to a geography-focused spinoff. The companies all do very similar things. They all work in vertical market software. The difference with Lumine is being focused on media and communications. Instead of doing a lot of small acquisitions the way that Constellation does, they tend to do larger deals, and typically they're doing what they refer to as carve-outs. So they're going to big companies like Nokia, for example, that may have a division that they don't want anymore, that was started by a prior CEO or something like that. And Lumine will go in, buy the division for a good price, take it over, service the customers. And the key for the seller, like a Nokia, is they want to make sure the customers are in good hands. And that's why Lumine ends up winning a lot of these, because they've done this before. The sellers are confident that they can handle it. The reason the stock has lagged is partially due to Constellation software issues and AI, and we can talk about that more. The other thing is they haven't really announced an acquisition in quite a while, and these names tend to really move on acquisitions, and especially with Lumine that does less deals and bigger deals. M&A is even more important. The whole ecosystem now is trading, when I say ecosystem, I mean Constellation and the related spinoffs, are now trading around 20 times earnings, 19, 20 times earnings, which I know might sound high, but believe it or not, these stocks were trading at 30 plus times earnings just 3 or 6 months ago. So I think for companies of this quality, like Lumine, you're getting an outstanding chance to step in now at these levels, here in the $25, $30 range.
All right. I hope that works when Mike is making decisions. Let's go to Adam in Toronto with a question. Hi, Adam.
Hi, good day to you both. My question is on the ticker FAR. Now, I think this is one of the world's largest drilling companies. I could be wrong there. It's now trading at, I think, 6 times EV/EBITDA with a record backlog. I'm wondering, is the market still undervaluating the mining CapEx cycle? Thank you.
Okay, thank you for the question. Very good pointed question about where this is going. What do you think?
Yeah, so Foraco is a mining services company. They have a water division as well. The closest peer, for those who might not be familiar with Foraco, would be a company called Major Drilling, which is about 3 times the size and does similar things. The drillers haven't participated as much as I would have thought in this mining cycle. Usually when the mining names are running, you'd have the tangential names like the service stocks running too. And Foraco has improved a little bit. It was trading under $2 for quite a while. We have owned the stock in the past. We don't own it now. The utilization is still a little bit low. The company has talked in the past about diversifying out of high-risk areas, diversifying away from junior mining companies, although they still seem to have some reliance on junior miners just based on where their utilization is. The stock is cheap. It's been cheap for a long time. This is another one that I think could get taken out at some point. But back to the caller's question, the stock is cheap, and I'm surprised it hasn't run up a little bit more given where we are in the mining cycle.
Okay, so there is a chance that some of that business and drilling could go its way, but we just don't know when that might pick up. Usually is there a delay if you have a pickup in mining to mining services?
A little bit, because what happens is you get all these mining companies raising capital, which is what we've seen this year, and then they go and put that capital to work. And as they're putting the capital to work, companies like Foraco and Major Drilling will benefit. So you're right, there will be a little bit of a lag. But like I said, we've been in this mining cycle now for, call it a year or so. I would have expected utilization to be a little higher. I would have expected the market to respect the drillers a little bit more. It doesn't seem to be happening, but Foraco's a well-run company. Stock's cheap. I think long-term you'll do just fine.
All right, let's go to Robert then in Burlington, Ontario. He's got a question. Hi, Robert. What's your question today?
Good afternoon. I'm holding Well Health Technologies. I've been holding it for a couple of years, but recently when it dropped below 380, I've been buying a ton more, and even the company's buying a lot more below 380. And I think one of the problems is short sellers are in there picking on the company. What are your thoughts on Well Health, and where do you see it going? Thank you.
Thank you for the question. So they do healthcare facilities. Can you give me sort of an expansion on what they do?
Sure. So when the company first started, which I'm going to say was probably around 2019, 2020, if memory serves, the idea was to really create a digital healthcare company. So if you remember at the time during COVID, digital healthcare got very hot. If you look at the chart, you'll see Well Health did incredibly well. The founder, who I know has had previous success with other businesses, and I think a lot of investors have a lot of confidence in him. His name's Hamid. Over time, the business kind of changed a little bit. They bought a company called CRH Medical, which is actually has physical locations as opposed to their focus on digital. And I think that was necessary just, again, to help sort of backfill some of that valuation that had gone a little bit crazy. They've done a number of acquisitions. I think some investors have picked on integration of those acquisitions a little bit. Some investors have picked on the idea that those companies that they bought maybe don't necessarily fit together. So I think we're still kind of early innings and seeing exactly what this becomes over time. But again, very strong CEO, good following on the street. I've never owned the stock myself, just mostly due to valuation. When I first saw it, I think the company had a 50 million market cap and they owned 4 doctors' offices. So there was just no way I could get my head around it. It kind of took off from there and have just never revisited. But again, well-run business. They're in a good space, digital health. If they can integrate and show the market really clear strategy, I think you should see pick up in the stock over time.
All right, we're going to take a quick break then. We will be back with Jordan's past picks. That's coming up next. time now to have a look at Jordan's past picks. These are from January of this year. And at the time he chose Go Easy was the first one, GSY on the TSX. It was 173.93 at the time, down to 132.45. So 24% drop in return, 21% total return drop. Go Easy today, Jordan, announcing a departure for an illness. Is this something that tends to hit the stock hard?
I think the stock was down about 4 or 5% when I stopped looking at my office this morning. This is a bit of a special case because this current CEO, who had to step down, unfortunately, just took over recently. The company also has an ongoing CFO transition as well, in addition to a short report that came out.
I remember that, yes.
From a U.S. investor. So when I picked this back in January, never did I think that we'd be dealing with a short report, a CEO change, and a CFO change all in the same year. I've been following Go Easy for about 15 years. I like to think I know the company intimately well. It's been one of the best performing stocks in Canada over the past 10 years up until this year. But what investors have to accept with Go Easy is a lot of volatility. I think it's a highly misunderstood stock. It's in non-prime lending, which is a sector that a lot of people don't like or understand. And typically when people get nervous about the economy, this is one name that gets hurt really hard. I mean, in COVID, when everybody wasn't sure what was going to happen, the stock went from 80 down to 25, but then it went from 25 to over 200. So you had a case where it was down almost 75% and then rallied 10x off the lows. And I've seen this with this stock a number of times. The bottom line is they're still very early days, $5 billion loan book in an over $200 billion market just in Canada. Leadership's very good. The original CEO is still there as the chairman, so there is good continuity. I will look forward to meeting the new CEO, but the bottom line is fast-growing company, over 20% return on capital, now trading at just 6 times earnings. This stock will rebound. I can't tell you when. It may take another quarter or two. People may need to see a couple quarters of clean growth, but I can tell you this stock's going back to $200 or more. I just can't tell you when.
Okay. So you still have faith in Go Easy. Let's get to your next past pick, which is Mainstreet. At the time, Mainstreet Equity was 203.01, which was January 15th of this year. Now it's at 184.55, so a drop of 9% and a total return drop of the same. And they do rental apartments, that kind of thing, which is kind of an in-between space, I'm going to say right now, because housing has been slow to come up. We've had a lot of changes to immigration policy. So this sector, real estate in general, has been lagging.
Yes, I think, but it's important to recognize where they sit on the real estate spectrum. So this is mid-market housing in Western Canada. Think 50 to 100 unit apartment buildings. Think $1,200 a month rent. Yes, your point is very valid. A lot of the demand can be driven by immigration and foreign students. But that being said, when you look at the supply and demand characteristics of the apartment market in Canada, there's only about 2 million apartments in Canada. And in past years, we've had over 1 million immigrants just in a single year. The other thing is they're not building any new supply. So to build a new rental apartment costs about $400,000 for one unit, whereas the units Mainstreet buys trade on about $100,000. So until there's less of a gap between those two numbers, you will not see supply come on. And I think you'll continue to see rents go higher. Whereas Go Easy's had some problems we were just talking about this year, I can't really explain to you why Mainstreet's down. Their financial results have been good. They've continued to acquire. They're on their way to 20,000 doors. The CEO still owns half the company, Bob Dylan. He's excellent. I've talked about him a lot on the show in the past. I just sat down with him last week or the week before for several hours. The story hasn't changed. The only thing that's changed is this is the lowest valuation we've seen in many years. So the company typically trades around net asset value or sometimes even a premium. It's at a 25% discount to net asset value right now. So I've said this before, I'll say it again on the show. This is, of all the stocks I own, this is the stock I lose the least amount of sleep over. And
this is primarily centered in sort of the western provinces?
Yes, so everywhere west of Ontario. Their biggest concentrations would be Alberta and BC in terms of the portfolio.
And rent control is not an issue in some of these provinces?
In all of these provinces, actually. This is the best part of the story. You've got a situation where they're able to get very cheap financing from CMHC, so we're talking 3% money, and then they can go out and buy these apartment buildings at very low prices. And they've been doing this for years and years and years. The track record's excellent.
Okay. So just for viewers' information, it was the end of last year that it hit a high of 212. And as we mentioned, it is at 185 today. Okay, let's get to your third past pick from January, Source Energy Services, SHLE on the TSX. $15.33 at the time to $12.81, or a drop return of 16%, same for total return. Tell me about Source Energy.
Sure. Source Energy is one of the largest players in Canada in frac sand. They have about 50% market share in Canada in frac sand. There's only a few players in this space. What the company does is transport sand from mines in Wisconsin up into Western Canada, and then they have fully integrated logistics division that will help deliver the sand out into the field where their customers need it. The nice thing about this company is they have long-term contracts with large cap energy players. So they have several large contracts, typically 2 or 3 years. They get reset over time as prices change. Sand has been identified as a highly strategic asset for a lot of the large energy companies. It can be a bit of a bottleneck in their process. I think the key thing here, well, a couple things. Quarter was a little bit weak. Management telegraphed that Q3. I think as we get into Q4 and next year, we've got the LNG Canada project, which I'm sure a lot of the viewers are familiar with. Management tells me that the demand for sand is increasing every single month on the back of that project, in addition to all the regular demands that they have. So I think it's a highly strategic business. It's trading at just over 2 times EBITDA, so it's very cheap. And I do think this company will get bought out at some point, either by a larger energy services company that wants to control supply, or maybe a competitor out of the US or private equity. But at this valuation, there's lots of room for it to move higher.
Is it a specific kind of sand that they need?
Yes. Frac sand is very different than the type of sand you'd find on the beach, for example. And there's different sizes and grades, and different customers have different needs based on their drilling and their budgets and things like that. But keep in mind, there was a takeout in the space last year, a sand business in the US called US Silica. And if you use the valuation in that transaction on Source, you get a $30 share price.
Okay, good to know. Let's take a quick break. We'll line up some more phone calls and emails for Jordan Zinberg, Bedford Park Capital, taking your questions today on Canadian small and mid-cap stocks. Back in a moment. Welcome back. We want to go back to the phone line. Sam's in Toronto with a question today for Jordan. Hi, Sam.
I would like to know your guest opinion about NIT Eyecare. And it's going up and down, up and down. You know, what's happening there? I would appreciate your opinion. Thank you.
Okay, thank you for the question. I think it's Quipt Eyecare
Yes.
we're talking about, which is out of BC, right?
Yes, Kitsilano, hence the name.
And this company, we've talked about a little bit, but is it something that's been on your radar? Have you owned it before?
Yes, I actually participated in the IPO. For those who aren't familiar with the company, it's an eyeglass company, but they operate almost exclusively online. So they have one store in Vancouver, and actually just this week or last week, I can't recall, they announced that they're opening a store in Toronto on Queen Street. But really, they want you to buy their glasses online, and I actually did just that. So if you can see the glasses that we have sitting here, these are actually from Kits, and I ordered them completely online. And you just upload your prescription from your doctor, and the company will give you suggestions as to what glasses might fit you. They even have a digital try-on tool. Where using your camera on your computer, you can actually try on the glasses and see what they look like. So these are great. I've been very happy with them. I've actually ordered a few extra pairs because I'm of the age now where I need to leave them all over my house.
We're all of the age. Yes,
So,
we are. Okay.
I think the business itself is an excellent concept. The founder had a contact business called Coastal Contacts, which he sold to private equity a couple years before starting Kits. So there's good pedigree there. Their main competitor would probably be a company like a Warby Parker in the U.S., although they're not
They're
in
here
Canada.
I think
Are
they're
they
here as
now?
well, yes.
Are they here now? So the main transition is just getting people to accept the idea of buying glasses online, which for most people is a big departure. They're used to actually going to the store and trying them on. But for busy people who don't want to deal with that, this is a great option. The stock had a little bit of trouble out of the gate, and then it rebounded nicely. But as Sam alluded to, it's been kind of all over the place. The company's been investing in the business quite a bit. As a result, profitability hasn't been quite where I'd like it to be, but it is a younger company. They are going through that cycle. I do think, similar to his previous company, that kits will get sold one day, but they still have a lot of runway. But yeah, great process, great product, well run, growing business, good Canadian success story.
How long does it take for the glasses to come, roughly?
Believe it or not, I think I had them the next day or the day after.
Okay.
It was, and that was what the company said to me, right, when they first met me. They said, just try our service, see what it's like. And I was really surprised, pleasantly surprised.
Okay, good to know. Let's go on to John. He's in Milford, Ontario. He's got a question today. Hi, John.
Hello. Good day. I'd like your thoughts on Bird Construction going forward. I've owned it for 3 or 4 months now at $24. Thank you very much.
Okay.
Bye.
Will Bird Construction be part of the larger picture for infrastructure projects? Is this something that'll benefit the company?
That's exactly where I was going to go off the top. You've seen Mark Carney's government announce a number of big projects, and you're going to see companies like Bird and Aecon, for example, are going to be the primary beneficiaries of those contracts. The company has a massive backlog. We do own the stock as well. It's a pretty small position, but we do own some in around the same level as the caller, that 24, 25 level. Stock did well for a while. Then they kind of missed their quarter and it sold off a little bit. And it's just been, I call it sawtoothing around that $25 level. That being said, I do think next year will be a much better year for the company. I think you're going to see growth resume. I think you're going to see some margin expansion. I think you're going to see some of these big projects start coming on. You're going to see more growth in the backlog. So Bird is a very well-run company. The way that they actually administer their contracts is also quite good, different than some other companies in this space. Helps them to sort of preserve margins and guarantee margins and not lose money on projects. So very well-run business, good disclosure. Results have been a little soft last couple of quarters. I think you hold on to it, and I think there's better days ahead for Bird.
I remember speaking to the CEO when they had missed their estimates. And part of the problem was the tariff overhang, and nobody wanted to build out because of the uncertainty. Does that have to dissipate or disappear before they can pick their projects up?
I think it kind of has to some extent. I think people are still figuring out exactly what this world looks like because nobody's even sure where we're going to end up on tariffs. But companies can't stop. They've had no choice but to just sort of continue. And if tariffs apply, then tariffs apply. But things need to get built. And yeah, I think we're all moving forward, although certain companies still don't know exactly how this is going to affect them long term.
All right. Let's go to Sal then. He's got a question. He's in Vancouver today. Hi, Sal.
Hi there. Yeah, my question's on McCoy Global. I know this is a stock that you've recommended in the past, and I was wondering what your thoughts are on this company, given that it's been on a bit of a downward trend recently. Thanks so much.
Okay, it has been on a downward trend pretty much since the summer. It traded sideways for a little while at $2.83. Not a lot of movement today. What's your take on McCoy Global?
Yeah, McCoy is a really neat little company. As the caller mentioned, I've had it as a top pick in the past. They're active in a very specific type of oil and gas technology, mostly products and services to make the wellbore safer. So allowing tools that allow companies to reduce the amount of labor that they need in the well, and also making their drilling much safer, which is a huge concern. They've got a number of products that will allow them to derive recurring revenue, which is a bit different for energy services companies. You don't often see that. Part of the reason for that is that when they sell their products, they also sell a service whereby customers can monitor what's happening down in the well from anywhere in the world. And there's an ongoing fee in order to do that. Company's been around a while, very well run, very clean balance sheet, no debt. It's not well known. I do think their new product that I've been referring to, their TRS system, they'll continue to win contracts and win orders over time. So yeah, I think McCoy's a winner. Energy services hasn't done great in general. This one's actually held up quite well. Rig counts are lower and spending's been a little bit lower, but long term, I think you're going to do very well with McCoy. And if you own it, I'd hold on to it.
All right, we're going to take another quick break then. Jordan Zinberg, Bedford Park Capital, taking your questions today. We're back in a moment. Stay tuned. Welcome back. Let's get to an email from Shiraz, who says, could I have your comment on whether Quipt, Q-U-I-P-T, Home Medical, is a hold? Do I sell at a loss, or do I dollar cost average? Thank you very much. We'll pull up the line chart. We were just talking about this company, which is out of Wilder, Kentucky. I've got it at $3.29. Is this a company you know pretty well?
I'd say I know it decently well. We've owned the stock in the past. We also own some of their debt in the past. I haven't caught up with the CEO, Greg, in a little while, but at-home healthcare, which obviously, again, was very popular during COVID. These stocks all did very well during COVID, and then coming out of COVID, I'm not going to say they've been left for dead, but definitely not as much as a spotlight on them. Quipt actually has had a bid, and I believe it was a non-binding offer. So I can't tell you exactly where that stands right now, but there has been interest in the company. The company hasn't really gotten a lot of love from investors over the last couple of years. So we've already had an offer here. It's non-binding. I don't know if the buyer plans to come back with a higher offer or a more solid offer, but I guess I do think this company will probably get taken out in the next little while, whether it's this existing buyer or not. As for the question about, averaging down or what have you, I generally don't average down. And
why is that?
Well, the problem is that if you buy a stock at 10 and let's say it goes to 7, some investors will say, well, if you liked it at 10, you should love it at 7 and you should buy more, hence the idea that you would average down. In my case, I think there's usually a reason the stock's gone from 10 to 7. So the first thing I would want to know in that case is why. Is there something different about the company? Or is this just a liquidity-driven situation where there was, let's say, an illiquid stock and a big seller and they needed to get off their position and they just sold it down? So first you want to know why the stock is down. But in terms of adding capital, I actually like to add capital to names as they move higher, which is a little counterintuitive. But if I buy something at 10, I actually want to buy more at 12 and I want to buy more at 14 because that means that out of all the names I own in my portfolio, I'm allocating capital to the names that are working. So what you don't want to do is buy something at 10, you buy more at 7, you buy more at 6, you sit around for a year while the stock trades between 6 and 8, and now you've got even more of your capital that's not working for you. So from a capital efficiency perspective, my own bias is to average up as opposed to averaging down. But again, in investing, everybody has to do things in a way that makes sense to them. And knowing yourself as an investor is really the best thing you can ever do.
For Shiraz, I just want to ask, there might be some sort of benefit to hanging on if a deal gets done as opposed to selling at a loss?
Yeah, so I would say if you have a better idea for that capital, then sell and move on. If you still like the company, like I said, I do think there's a chance that we get a transaction, and I wish I had spoken to them a little more recently so I could give the caller a little bit better insight. But there is, I believe, a non-binding bid on the table. So yeah, if you have a better idea for the capital, sell and move on. If not, maybe stick around for another quarter or two and see if you get your buyout and see if you get your 30% premium.
Okay, let's go to Scott then on the line. He's in Saskatoon with a question today. Hi, Scott.
Good morning. Hi, Morella and Jason. I'm just wondering about Calian Group on the Toronto Stock Exchange. It's come under the Plantro microscope recently, and their shares had a positive response. I'm just wondering if the guest has a target price and any comments about this Plantro involvement. Thank you.
Okay, so Calian at $56 flat right now, up 15% on the year. CGY and the TSX. What's your take on Calian?
Looked at Calian a few times over the years. It's a very good company. I think if I was running a more defensive fund, maybe something that looked at small cap income, this would definitely be something that I would own. For those who aren't familiar, they've got a couple different divisions. The business is run out of Ottawa. There was that Plantro involvement. For those who aren't familiar, it's the same group that's involved in Dye & Durham.
Shake it up.
And a number of other names as well. They put out a pretty good quarter, which is, I think, why you saw the stock pop. I believe I saw the stock hit a new 52-week high yesterday. So shares are doing well. In this case, the Plantro involvement seems to have helped. In the case of Dye & Durham and some other names, it doesn't seem to be helping. The stock's doing well. It's got momentum, seems to have shareholders' attention. I think you continue to hold it. I don't have a specific target price that I can give you, but it's a good, solid name. It's well run. It's got a dividend. And the activists appear to be doing some good on this one.
Okay, so I've got that it hit a high today, actually, 55.81, and it's up to 56 now. So, yeah, definitely moving the right direction for Calian. Let's move we do have to take another break. So we will be back with new top picks from Jordan when we come back. Stay tuned. Join us tomorrow for Market Call. Kim Bolton will be on the show. He's president and portfolio manager at Black Swan Dexteritas, and he'll take your questions on technology stocks. That is tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new top picks from Jordan. We are going to start with this first one, Zoomed Technologies, ZOMD on the TSX. So they do digital marketing. And do they sort of do digital marketing for other big companies? How do they operate?
So there's a bit of a theme today with my picks. I went, even though I'm a small cap manager primarily, I went small, medium, large because there's so much value out there. So let's start with the small one. It's Zoomed. It's an ad tech business. They have a lot of blue chip customers. So think of customers like Amazon, the NBA is a customer, Shein is a customer. And what they do is they help customers to unify all their sources and help strategically with their ad buying. So if you know anything about ad tech, you kind of have Google and Facebook and then sort of everybody else. They call it the walled garden versus the unwalled garden. And what Zoomed has done, incorporated about 10 or 11 years ago, developed some technology, did some acquisitions, landed some big customers, and they do have quite a bit of customer concentration. I think the top 5 customers are about 70% of the business. But what people don't realize is they tend to get a customer like Amazon, for example, and Amazon might say to them, okay, we'll give you Canada and see how you do. And then if you do well over time, we'll roll you out in other countries. So this one isn't very well known. I thought I'd give the viewers a bit of an early look on this one. It's a small position for us. They grew revenue about 70 some odd % last year, 20 some odd % this year. Profits are growing very fast. Again, high inside ownership. First analyst just picked up coverage last week. But I would say, the numbers are excellent. The reason it's not a bigger position for me is, first of all, pretty cyclical industry, ad tech. Second of all, the company's disclosures are not very robust. Let's just put it that way. So if you look at their MD&A last quarter, I think it was 10 pages. So I'd like to see a little bit more disclosure from the company in order to get some confidence and build that into a bigger position.
Okay, let's get to your next pick, which is Propel Holdings, which made an announcement today about moving forward with a bank. And is this something that was expected? Is this a reason at all why you picked Propel?
I mean, there's a number of reasons why I picked Propel. I could probably do a whole show on Propel, and I've talked about Propel at length before. But to your question about the bank, the company had hinted at a number of strategic initiatives a couple quarters ago on their call, and we started to see that now. And the CEO was on the show just before me, so I didn't get a chance to catch the whole interview. But just a week or two ago, just after earnings, they announced a partnership with a bank in California. Now they've actually announced that they're going to be their own bank. And I haven't had a chance to speak to management yet about all the implications. I sent them a congratulations note this morning. But I think what it will do is it'll allow them to reduce costs by performing some of the things that they had to hire other banks or partner with other banks to do before, and will allow them to launch new products and services. Again, I don't know the full depths of this announcement just yet. It was just this morning. Why do I like the stock? One of the best profiles in Canada, growth profiles in Canada of all the stocks we follow, trading at a multiple of about 6 times forward earnings right now, which that's really more of a distressed multiple. And here we have a company that's been growing at 30, 40% a year, trading on 6 times earnings. And I guess to top it off, you look at the news this morning on this Laurentian acquisition. Laurentian is a company, and no disrespect for Laurentian, I have friends who have worked there. They've had declining earnings for years. They've got a 9 or 10% ROE, and they get taken out at 12 times earnings. And then we have a company like Propel that's growing like crazy with a 30% return on equity, trading at 6 times earnings. So there's huge dislocation here. It makes no sense. I'm going to pound the table again on Propel. I think the stock is going to rebound very nicely. And I think at $25 here, it's a no-brainer.
All right, let's get to your third pick then, which, as you mentioned, you went small, medium, and then large, Constellation Software, which we did touch on earlier from some of the spinoffs. But there are AI concerns about this kind of business, which generally takes software companies and sort of oversees and makes them a little bit better. Are you worried about that in the case of Constellation Software? It has been on a downward slide since the summer.
Yeah, so I think there's 2 things. As you alluded to, some investors are concerned about the threat on AI on their businesses. And then secondly, we had a surprise CEO resignation for health reasons, and I hope Mark Leonard is doing well. He was revered, I'm not going to say as much as maybe a Warren Buffett, but in that type of realm for people who know him and know the company. So him stepping down was a bit of a surprise for everybody. On your AI question, I think it's too early to answer that question. Even the company themselves have said that it's both an opportunity and a threat. This is a big company with a lot of resources. They're already using AI in their own products. And keep in mind, these are hundreds of software companies that they own. So what they're able to do is take best practices from an AI perspective from one company and then use that knowledge from another company. So I'm not going to say that it's not a threat. I think it would be too dismissive to say that. I think we're still really early, but what I do see is one of the best companies in Canada, compounds capital at a very high rate, and you're now able to buy the stock on a multiple that we haven't seen in probably 10 years. So one of the only large cap stocks that I own, I've owned it forever. I don't know how quickly we'll get back up to $5,000, but down here at 19 or 20 times earnings, I think you're getting a phenomenal entry point for investors who don't own it.
Do you feel confident about the person who's going to lead it forward?
Yes. So Mark Miller is the new CEO. He was president before. He's been at the company for 30 years. And if I'm not mistaken, his company was actually the first acquisition that Constellation did. So he might not be Mark Leonard, but pretty close.
Okay, as close as you can get. All right, we will leave it there. Thank you very much for joining us, and good to see you. A quick market update as we head towards a break, just to see where we have landed so far on the day. The TSX, a bit of a comeback so far, in the sense that it's only down 104 points right now to 30,997, so under the 31,000 mark. The S&P 500, just a 7-point move right now. And the NASDAQ, 104 points up on the day, almost 0.5%. That's where we stand. Thank you for joining us today on Market Call. We'll see you back here again tomorrow.